I just don't like the direction that everything is heading because it's just forcing euphoric behavior. It's forcing assets to get really expensive. And I do think this won't end well. So there is definitely consumer problems lurking here. It's just a matter of time when this comes. And the biggest problem I have with all of this is Jerome Powell stated that inflation's going to be remaining a little bit higher for a little bit longer, and they're going to keep rates elevated for longer. But what we have to understand is that we're already spending 50 to 100% more on our items, and that's just going to go higher and higher and higher. Welcome back, everybody. It has been a minute since I've posted, and there's a lot of things I'm going to talk about in this video. We're going to get more into the macro nitty-gritty data, but I am going to drop a video on a company called Black Rifle, which is a coffee company, military-owned company that I'm personally interested in. I haven't done a dive into it yet, so I'm going to do that live and see what we come up with for a DCF model. But today there's a few things I'm going to talk about. As most of you know, I've been working a new job, which my goal is to accumulate some money here because I do think we're in a euphoric behavior with the investor, and I think it's going to get very bubbly very soon. And I think by next year, we're going to have tremendous opportunities. And I want to talk through why I think that is. First, I want to just talk about the investor in general. A lot of new money is going into a market that's, in my opinion, formulating a top here really soon. And I have no interest. I'm getting no FOMO in anything that's taking place because I really truly believe there's some big problems around the corner here. And one of the other indicators that I'm keeping an eye on is actually the VIX. Now, the VIX is the fear and greed meter, but really it's essentially investors buying insurance for things that could happen here. It's the volatility meter. And so when we look at where the volatility meter is, there's a tremendous amount of complacency within the investor and a tremendous amount of greed within the investor. Not only the investor, but a lot of hedge funds now are pushing their targets up, forcing more euphoric behavior within the investor. And we all know the old saying by Buffett, be fearful when others are greedy and be greedy when others are fearful. There is absolutely no fear in this market. And when we look at a historical standpoint, where I start getting interested in the market is when the indexes are trading between 17 to 18 times earnings. And we currently have an S&P 500 trading at a 26 multiple while we have short-term yields at 5%. So we have to start asking ourselves, at what point does the risk versus reward make sense? It doesn't make sense when we're trading at extreme multiples to possibly lock up some short-term yield, take some chips off the table. I'm not saying all of them, especially if you got great price averages in a lot of your stocks. If you have great price averages in a lot of your stocks, maybe taking some off the table, locking up 5.5% to short-term yields could make a little bit of sense here on some sort of possible pullback. We just haven't had a pullback in a significant amount of time. And we all know that there's a tremendous amount of liquidity still in this market, which means that euphoric behavior could still go higher. But what concerns me the most is not necessarily the euphoric behavior. It's the debt crisis that I think is looming within this government spending. And we're going to talk about that here a little bit. So when we look at government spending here of full year to date 2024, Social Security is number 1, healthcare is number 2, national defense is number 3, and just behind national defense is net interest. And this is becoming a huge red flag for me. This is becoming extremely concerning because when we look at fiscal responsibility within the globe, sitting at 129% debt to GDP, United States ranks as one of the last countries that's actually fiscally responsible. And this is where we're starting to see bubbles formulating, not only in the stock market, because the stock market is essentially a liquidity machine. So the more that the government spends, the more that machine is just going to keep going higher and higher and higher. But underneath, are we starting to see cracks? And listen, guys, I'm going to keep this as simple as possible. When you go grocery shopping, when you are buying anything right now, it is definitely 50, 100% more expensive, whether we're talking about gas that used to be $1.75, now pushing $4 a gallon. When we talk about just grocery shopping, I think my groceries on average are up 50, 60%. And even though payroll is showing a tick up that people are actually making more money, it's definitely not keeping up with inflation, not even close. So a few things that I'm personally looking at and keeping an eye on, the house of cards that this all lies on, ladies and gentlemen, is going to be the labor markets. As long as the consumer has a job, we'll probably see markets still go higher here. But when that reverses, it is going to be a whipsaw effect, in my personal opinion. not only from a technical analysis on this market, but also the fundamentals underneath. If the consumer runs out of money, how are they going to spend, and how are corporate earnings going to keep up with the expectations of earnings growth? So that's the biggest problem I have. Essentially, we're spending trillions and trillions of dollars, growing our deficits 5, 6, even 10% in some years, but we're only growing GDP by 2 and 3%, which is pretty disgusting when you really think about it. But the thing I'm keeping an eye on is not only unemployment, because that's going to be a key factor in everything, but it's actually hours worked here. As we can see, inflation's been a big problem, but people are working less hours, which means they're actually taking home less money, even though that they're stating that payrolls are up. So even though people are getting raises and income levels are going up, the hours worked are coming down. And to me, this is burning the wick at both ends when we talk about a consumer that needs to be strong throughout the whole fiscal year in order to really gain that $250 of earnings that the market is expecting, which means that we're still trading well above 20 times earnings and currently trading at 26, 27 times earnings. So regardless of what metrics you're looking at, in my opinion, we're definitely overpriced. From a market standpoint, probably 20 to 30%. But if earnings deteriorate, it is going to be a greater percentage than that. Meaning if earnings come in well below $250 a share, then we are very expensive. And honestly, guys, I don't see any reason to be jumping in this market if you haven't gotten in early enough. I would not be adding new money personally to this market. I would actually be looking at taking on short-term duration because 5% risk-free is very competitive, in my opinion, where valuations are right now. So we can see that the consumer was working 35 hours a week, now working between 34.2 to 34.3 hours a week. And that seems fairly healthy, but what's starting to become interesting is unemployment is starting to tick up here. We went from a year ago, a little over a year ago, we went from 3.4% unemployment, now pushing up to 3.9% unemployment. And so we're starting to see a tick up in unemployment. And as you guys can see here, when unemployment starts ticking up, it is a fast move to the top here when we start seeing a pretty substantial tick up in unemployment. Nothing's really drawing a red flag here. I think when we get above 4.2, 4.3% unemployment, and if we keep hours low, and if hours keep kind of trending down here, that's going to signal a red flag for me personally, because I think that's when we're going to see a pretty significant spike up in unemployment, and I do think it could come by the end of this year. So why is this a big problem for the deficits? If we see unemployment tick up with the type of government spending that's taking place here, we're going to have a heck of a deficit. I want to explain the deficits here. The deficits are offset by tax income that's received. So this is a good visual for 2023. Government collected $4.44 trillion in revenue, but spent $6.13 trillion. Now, if we take out the pandemic, I think we understand that we had to spend during the pandemic and people weren't going to work, so collections was probably low as well. I'm not going to dive into that today, but I'm just assuming here that when people were at home, there wasn't many taxes being collected, and we also had to spend more to put money in people's checks so they could buy groceries and actually live their life with. Otherwise, it would have been chaotic. But let's fast forward to where we are today. We're a few years removed from the pandemic. And take a look at these deficits here. The deficit is nearly $2 trillion, okay? I want to put this in perspective. When the world was completely shut down and people were not at work and collecting paychecks, we were at a $3 trillion deficit. Let's fast forward a few years, because obviously we know that it takes a few years for things to kind of normalize again. Fast forward to 2023, we're at almost $2 trillion of deficit, $1.7 trillion of deficit. This to me is pretty friggin' disgusting because we've already given people a tremendous amount of money. The government has been spending for consecutive years because of the situation we were in. But the fact that we're starting to see a tick up in this deficit is a massive problem, because when we go back to one of the original slides here, net interest on our debt is starting to creep past national spending. So if we get a spike in unemployment this year and they're not collecting tax money, but yet they keep spending because that's what they're putting, they just passed another bill to not have a shutdown of over $1 trillion of spending. And so we can see that the government spending is probably not going to slow down here. And if we have a spike in unemployment, that means that they're not collecting tax money. So what does that mean? That means it's probably going to surpass both healthcare, national defense, and probably creep up to Social Security. Social Security to me is going to be the biggest way for the government to fix the deficit spending. Even if interest rates go down, the amount of spending going forward, and when we look at the job creation that's taking place, it's a lot of government jobs that are actually being created, which means that government spending is still going to be at a high level. And even if the interest rate gets cut in half, this is still going to be a pretty substantial problem. I don't think we're going to see interest rates back down to 0.5 to 1% anymore. I think we're going to be normalized in a 2 to 3, maybe even 4% level, which means that, if government spending keeps going up and we have unemployment ticking up, this is really not going to impact the net interest spending that's going to take place, even though right now rates are a little bit higher, and that's why we're seeing it, I think, tick up on the government balance sheet. Kind of where we are in the economic cycle, we're really in a peak of everything. We're in a peak earnings market, we're in a peak labor market, the consumer's in peak spending behavior. So the interesting thing is, I thought we would see M2 coming down more, and we're not. And that's just because the government is still pushing out liquidity here. So it's like a battle between the feds and government spending. It's pretty interesting. But at the end of the day, when we think about who Jerome Powell's boss is, it's essentially the president. The Federal Reserve basically said they're slowing down on releasing the balance sheet. They're going to keep rates where they are. And I do think this won't end well. And even if you take my thesis off the table and how I'm breaking down what I think the biggest problem is going to be over the next, call it 2 years or so, we're still trading at extremely high levels here. A 26 multiple on an S&P 500. Now, everybody wants to talk about a forward PE sitting at 20 times, which is about a little elevated, but not too crazy. I just don't know if that's true, because I do think earnings can deteriorate pretty quick. And we're just seeing massive divergences here, even within some of the earnings calls that have taken place. A couple I want to point out here that were eye-opening to me is going to be Nike, which, usually trades for above $100 a share. Obviously, the October lows, it hit a low, I think, around $65 to $68, but now is below $100 a share. And that, to me, was obviously due to earnings, but we're starting to see that consumer kind of slip here. They're not willing to spend on those high-ticketed items, those luxury-type items. And to me, Nike's one of those brands where when the economy's doing well, Nike's going to do well. And, we're starting to see that shift in the consumer here, where the risk, where that upscale appetite to spend over $100 on a pair of sneakers might just not be there right now. And to me, these are the small cracks that we're starting to see within the consumer, and it's starting to come through in the stock market. And this is why I think earnings can deteriorate. I'm using Nike as a jumping off point because we're early on in the fiscal year and earnings are just starting to kick off. But to me, this is an actual pretty significant sign to me that we are going to see the consumer really, really slow down here. And the only companies that I believe are going to have kind of insulated earnings are going to be those technology companies that are trading at extreme multiples already. So this is a pretty interesting setup to me. And the other thing that was actually pretty eye-opening recently was the fall with Dollar Tree here, going from basically $140 a share down to $125 a share. Dollar Tree closing 1,000 stores, to me was telling me that the bottom half consumer is probably in trouble if Dollar Tree's not doing well. And so when I look at Nike and I look at Dollar Tree, to me, these are kind of forward-looking mechanisms going on to later in the year when we see that consumer really, really possibly slow down here. Now, I'm just kind of lining up when we look at the hours worked coming down, when we look at unemployment ticking up, and we look at these two type of earnings kind of faltering here. Are we seeing something going on with the consumer that's flashing a red signal here? But when we look at what's going on the surface level, it's really technology carrying everything. Yes, we're getting a broadening of the rally, but technology is really the ones that's getting multiple expansions, and they're really the ones that are going to have earnings kind of insulated, where they're not going to be as vulnerable as some of these consumer discretion type names. But a Dollar Tree closing 1,000 stores is kind of shocking to me. I definitely think there's deterioration taking place. And I know for me personally, we're starting to really focus on putting money away because things are just getting so expensive. We're trying to pinch a penny. We're trying to put capital on the sidelines because I do think there's going to be a lack of liquidity as time goes on. So now I just want to take it to the technicals really quick because I've built a story here and I want to show you what's going on here. Now, obviously, I said that we're in a euphoric stage. This chart behind me right now is actually January 2020 or January 1999 all the way up to current date. And we've been trading in a pretty functional channel here that we've recently broken out of. And that breakout could be absolutely a bullish signal, and we could be going higher, and there could be tremendous euphoric coming in, and no questions asked that definitely could happen here. But the thing I'm paying attention to is that black line underneath. That black line underneath is the 75-day moving average. And this tends to be a pretty good opportunity when we start approaching these levels. As you can see, the October lows. Down here, the 2009 financial crisis broke below it. .com bubble behind me broke below it once again. And so we haven't really touched this 75-day simple moving average in some time. And what we're getting is a euphoric move, which is pushing that 75-day moving average pretty high. And I do think we will come down to earth, and I do think it will be a deficit problem that's going to take place here, and or more inflation because of the government spending that's taking place, where rates could remain elevated for much longer than everybody anticipated. And I'm talking going into 2025 when we have a tremendous amount of real estate that needs to be refinanced, which is another ticking time bomb that could be around the corner. So I'm starting to look at this. I'm starting to look at the valuations on things, and I'm definitely not getting any FOMO here. With individual names, there are some FOMO things that have taken place. I mentioned a lot of stocks on this channel that we've broken down together, and I tried to create this channel to show my journey here, and so I sold out of a lot of positions. One of them being Raytheon. I thought the macro backdrop suited well with the government spending coming in, and I thought where we were in the economic cycle, Raytheon could do well, and the valuation was definitely in line. I think it was in the low 70s, high 60s, and it's just done nothing but go up. I think it's trading in the 90s right now. Currently trading at $95 a share. We talked about a bunch of other companies. We talked about, Verizon was another one that hit $30 a share. It was paying over an 8% dividend at those levels. And it looked like the dividend was going to be fairly safe. Payout ratio got high there for a second, but I think they've figured some things out, and it ended up working pretty well, as now it's trading for $40 a share. So you would have had an 8% dividend yield along with a 23% gain. That's a 31% annualized gain on a company like Verizon. And so there was definitely those opportunities. We even mentioned Bank of America when Bank of America got down to that $16, $17 level, now trading in the mid 30s. But right now, I'm not seeing a tremendous amount of opportunities. But right now, I'm not seeing anything that really sticks out to me right now. Obviously, I will be diving into Black Rifle Coffee. That's probably going to be the next one. But hopefully you guys appreciate my perspective on things. I'm not saying I'm always going to be right, but I'm definitely seeing some big problems that could be coming around the corner here. And I do think that there's more euphoric behavior coming because all the experts and analysts are pushing guidances and price targets up, and that's forcing retail investors to jump in at the top of the market. And when I look at kind of some of these earnings calls coming out, it's definitely a mixed bag of tricks. When we topple that with that, and unemployment is starting to tick up a little bit, hours worked are starting to come down, and we have deficits running at pretty extreme levels with multiples at extreme levels. To me, it just doesn't bode well longer term here. Maybe in the short term you can have some trading opportunities, but in the longer term, I don't think that this is a fundamentally strong setup. As always, guys, really appreciate your time. Thank you so much for spending it with me. We will see you in the next one.